So what stimulates the economy better, raising wages or cutting taxes? This presentation will explain and show you how raising wages increases activity in the economy much better than tax cuts, and we will actually use the Trump tax cut for the wealthy and show how it was spent. So we're going to raise wages on one group, we're going to give a tax cut to another. So our first group is 100 people, each get $10. Our second group will consist of 5 people who make over $400,000 who receive a tax cut of $111, and 4 companies who receive a tax cut of $111 plus an extra dollar, so that we can say $1,000 was given to both groups. So let's start from day one with the group that have their wages, which are raised. 100 people each receive $10, so they spend $5 on housing. They spend $2 on food. They spend $1 on utilities. And they spend $2 on consumer goods. This happens 100 times with 100 people, so the economy is raised by $1,000 because the money is spent and stays active in the economy. So day one, the individual spent on housing, food, utilities, consumer goods. So day two, those entities who receive the cash, they turn around and they spend their money on utilities, service, repair, wages, jobs, and goods. Again, the entire $1,000 is spent. So $1,000 has been added to the active economy again, or $2,000 by the end of day two. And if we break it down, we see that the landlord spent $2 on utilities, $2 on service, $1 on repair. The grocery spent $1 on wages, $1 on utilities. The company spent $1 on wages, and the consumer goods company spent $1 on wages, $1 on goods. So at the end of day two, the $10 was completely spent and received by the owners of the utilities, the service, the repair, the wages, and the goods. So we're going to repeat this for another 8 days. The initial $10 spent by 100 people of $1,000 continues to move through the economy. So by the end of day 10, raising wages by a mere $1,000 has multiplied through the economy, changed hands for 10 days, and now equals 10,000 in the economy. Of this 10,000, 4,200 has gone into wages or jobs, or 42% of the total. So let's take the tax cuts. The 5 individuals who make over 400,000 all receive a tax cut, and they spend it on the following: 22.5% on housing, 22.5% on savings, 22.5% on stock, and 32% on consumer goods. So for these 5 individuals, they spent 25 times 5 on housing, which is 125. Same for savings, and same for stock. And finally, consumer goods, they spent slightly more, 180. So this side of the equation, they've spent on day one, $555. They've spent all of their tax cut. So day one tax cuts for the companies now. The companies have each of $111 that they are going to spend. They will spend it in the following percentages, which reflect the Trump tax cuts of 29% on equipment factories, 35% on stock buybacks, 11% on R&D, and 25% on dividends. So again, we have 4 companies, so the goods times 4 equals 128. The stock buybacks times 4 equals 156. The R&D times 4 is 48. The dividends times 4 is 112 plus 1 because we have to round it off. So the company total was 445. The people total was 555. So day one, the tax cuts were completely spent $1,000. So now let's go to day two for the tax cuts, and we'll start with the 5 individuals who originally spent money on housing, consumer goods, savings, and bought some stock. So the housing cash goes to utilities, service, repairs, and wages. The savings of $25 enters the bank and comes out as a loan of $20, but $5 stays in reserves. The stock purchase generates no cash until a future date, savings. The consumer goods cash goes to wages, goods, and utilities. So day 2 for spending of tax cuts by individuals generates, out of 111, it only generates 81 because we lost 5 to reserves in the bank loan and we lost 25 to stock. So at the end of the day, day 2, individuals only generated $81 times 5, which is $405. And wages are 125. You can see 25 times 5. Wages are $125 of this. So now day 2 of the tax cuts for the companies, we see that they initially bought goods, they did stock buybacks, and they bought R&D and dividends. So on day 2, the stock buyback cash does not re-enter the economy. The investors they bought from just buy more stock. The R&D money flows to wages, goods, utilities, and housing. And the dividends are either rolled over to purchase more stock or are taken as income wages. So of the $111, we now had $39, which were the stock buybacks, and half of the dividends, which go to rollover, leave the active economy. So $53 per company has left. And if we look at it here, we can see more graphically that the recipient of the goods, the $32, they spent on wages, goods, utilities, housing, whereas the stock buyback injected no cash into the economy. The R&D did, and the dividends, only half of the money went back into the economy. So at the end of the day, day 2, the companies have only generated $58 out of the 111. And so times 4, that's $232, and we see 160 went to wages or jobs. So let's talk about stock buybacks. These actually artificially increase the value of a company. Buybacks reduce the number of issued or outstanding shares by buying them back. And if you base value on earnings per share, fewer shares means higher earnings. We'll look at an example, a company that earns $100 million a year but has issued 200 million shares. Their earnings per share is 50 cents. And if you take a stock price that's 20 times that amount, you get a stock price of $10. So now you buy back some shares, you still have earnings of 100 million, but now you only have 150 million shares outstanding. Your value has gone up. Your earnings per share is now 67 cents per share. Your stock price rises and goes up about 30%. So what's another reason companies buy back their own stock besides earnings per share? On their balance sheet, a share repurchase will reduce the company's cash holdings because you paid cash for the stock, which reduces its asset base by the same amount of the cash you just spent on the buyback. And it also will simultaneously shrink shareholders' equity on the liability side by the same amount. So as a result, performance metrics such as return on assets and return on equity typically improve subsequent to a share buyback. This makes a company look much better on paper to prospective investors. So on day 2, the companies added $232 and the individuals added $405 for a total of $637. So out of the initial $1,000, $363 has now left the active economy. So day 1, we spent $1,000 with these tax cuts, but day 2, only $637 was generated in the economy for a 2-day total of $1,637. And if we continue that for 10 days, the tax cuts will have generated a total of $5,947 in the economy. Of this, $1,474 went into jobs. So at the end of 10 days, the $1,000 of tax cuts has added just under $6 $100,000 to the active economy. And of this amount, the wages jobs received about 1,500 of this amount. At the end of 10 days for the $1,000 that raised wages, this has added 10,000 to the active economy. And of this 10,000, 4,200 has gone into jobs and wages. So raising wages stimulates the economy almost twice as much, and it provides more money for jobs and wages than tax cuts by almost 3 times more. So say we raised wages $1,000 for an entire year, that would multiply out to $365,000. Whereas if we take this further and extrapolate further, say we raise wages by 4 million, okay, say we went to $15 minimum, we raise the economy, the money in the economy by almost 1.5 billion, from 4 million, 1.5 billion. Whereas cutting taxes of 4 million results only in 400 million, or 40% less. It's missing $500 million. Raising wages also increases wages and jobs for others, adding $600 million for jobs, whereas cutting taxes only adds about 250 million, or 60% less. So you can see, if you take the numbers, if you actually take it down to the level you need to look at this, raising wages always stimulates the economy better than tax cuts. Tax cuts are not about raising the economy, stimulating the economy. They do not do that, and there's no history that shows that they ever have.